Welcome. Have you ever played fantasy football? Or any fantasy sport for that matter? The concept is that at the beginning of a season, you form a league, say of 10 total teams. Each team is going to have a manager of their team. Then you have a draft where each manager has an opportunity to choose players from the real world to play on his team. It's a fantasy league because you are making up a team of all the best real players you can draft. Don't forget that 9 other managers are trying to build the best team also. Each real player can only play for one team in your league at a time. Then, as each week goes by, the real players play their games, and based on certain things, that they do in their games, you get points for your fantasy team. Like running yards, or catching a pass, or running after you catch the pass, or maybe kicking field goals. Each fantasy team is playing against another team in your league. The team with the most points at the end of the week wins. For me, for some people, it's a lot of fun and another way to cheer on real life players. Hello. If you've seen some of our videos before, you know that I'm Stephen Mansell, the COO here at Kodiak Capital Advisors. And here at Kodiak, we believe that the more you know about the market and how it works, the wiser your choices in the market will be. Now, today, what I'd like to talk about is mutual funds. Now, up front, I want to say that there are multiple variations of mutual funds available. Today, we're going to take a look only at some of the basics of mutual funds. To begin, a mutual fund is a collection of assets that are bundled together as a unit. This unit will have an intrinsic value based on the values of the assets within the unit, minus the liabilities. This is called the NAV, or NAV, which stands for net asset value. Over time, the NAV will change because the individual asset values in the fund and the liabilities will change. What the investor wants, of course, is to have the NAV increase. In fact, he wants it to increase faster than other investments. The sometimes mystical draw to own mutual funds is the fantasy that someone who is brighter than you regarding the market is going to pick multiple winners in the market, bundle them together, and then you will have a share in that winner's asset. Now, anyone can put together a mutual fund, register it with the SEC, and offer it to the public. Typically, that person decides they can pick a group of winning assets that, when put together, will outperform the S&P 500. They also have to choose which assets are going to be losers too, and they leave them out. This collection of assets becomes the mutual fund, which actually becomes a single asset, something which can be bought and sold on the open market. It's like that fantasy football coach that picks the best players at each position. He is betting that his players will score more points each week than any other combination of players, and that they will continue to do that for the whole season. The problem is that I've run into, some players get injured during the season for real and can't produce like before. Or the team of one of your players changes its on the field strategy, and now your player doesn't play as much, so he doesn't score as many points as he did or as he was projected to. Whatever the reason, your collective team doesn't perform as well as your opponents, and so you lose. The other factor that contributes to the NAV are the liabilities that must be subtracted from the total value of the assets. Two of these liabilities are management fees and the cost of buying and selling the fund's assets. Now, depending on the frequency of a manager's supposed need to buy and sell assets within the fund, the broker's commission of those assets is passed on to the investor. They become a liability. The management fees are set by management. If they are beating the market by, say, 10%, then charging a 5% fee is okay. But because if you subtract that 5% from the 10, you're still making 5%. You're beating the market by 5%. Sure, it's okay to pay the management 5%, but the fund won't always beat the market, and soon the 5% fee takes it below the market. Let's look at some of the reasons why a mutual fund doesn't perform as well as it has or as well as projected. First, migrating managers. Mutual fund managers that do really well will be noticed by bigger corporations. They will try and lure them away. And if they're successful, who knows if their replacement will have the same Midas touch, or will they have the anti-Midas touch? The investors have no say in who the manager is. The second is what we call asset elephantitis. When a mutual fund is doing well, others hear about it and they want to get in on the profits. They pour their money in, which means the fund manager must either buy more of the same assets, which will drive their prices higher, probably driving them to become overvalued. When the market figures that out, the price will fall, which will lower the NAV of the fund. Or he'll have to decide to look for other future winners. Now they will need to keep track of even more assets. Or he can decide to hold on to the cash for later use. But that will probably in time lower the NAV because the stocks will outperform that cash. The third way we call fancy footwork. Sometimes in the beginning of the fund, the manager will waive management fees to keep the NAV higher. When enough money has come in, they will add their fees back in and a little more to catch up lost revenue, which most investors will not even notice. Fees are a liability which will lower the NAV. Now, these reasons and several others are why mutual funds do not always keep up with the S&P 500. They don't even keep up with an index fund based on the S&P 500. Now, in a future video, we'll look at some of the reasons why a mutual fund can keep up with the S&P 500. This video has presented some general information regarding the financial world. To talk with me or someone on our staff about your specific situation, your specific portfolio, click on the call button below and we will contact you as soon as possible. There is nothing like a conversation to clear up uncertainties. If you found this video helpful and you would like to see other informative videos, or you think others would benefit from them, then click the like and the subscribe buttons below. If you have a question or an idea for a future video, write us a note in the comments. In future videos, we will be going through some of the ways people have used to gamble in the market, and we will compare it to how the intelligent investor would decide to risk his money. I'm giving you examples to show how this financial concept of portfolio management works. But I want you to remember that every individual will have individual results in these situations. Do not think the specific outcome of these examples will be your outcome, and therefore make financial decisions based on it. But instead, we want you to recognize the general rule we are illustrating about portfolio management. Remember, choose well.